us, ladies and gentlemen, to all our Form 4 candidates who are watching us from across the Republic, wherever you are. Today is yet another privilege that the Almighty God has granted us an opportunity to be on this stage of KUTV, your #1 channel of giving you the education programs. So we are here on stage once again to take you through business studies Form 4 under the 844 curriculum. My name is Humphrey Sasia. I am a teacher. I'm going to take you through business studies, a topic of financial statements. That is topic 1 in book 4. Now, just before we move forward, I wish to notify you of the specific objectives that you are supposed to achieve at the end of this lesson. So, business studies, Form 4, specific objectives. By the end of the lesson, the learner should be able to explain the meaning of a financial ratio. 2, should be able to identify and explain different types of financial ratios. And then 3, you should be able to work out the different illustrations showing the financial ratios. Those are the specific objectives of our today's lesson. Introduction. So what is a financial ratio? A financial ratio. First of all, what is a ratio? Before we look at a financial, what financial ratio? So what is a ratio? So in this case, a ratio is an expression of an item in relation to the other. It is expression of an item in relation to the other. That is a ratio. Now, what is a financial ratio? So financial ratios are expressions used to compare the performance of business enterprises in different areas for decision making. So if you take the items, compare that at the beginning of this particular trading period, this was the capital that was employed. Now, at the midst of the trading period or at the midst of the year, this is the amount of capital that has been garnered. Then at the end of the year, this is the amount of capital that has been garnered. So if you want to check the buying price vis-a-vis selling price, you get the difference, be it negative or positive. You can get it in form of a ratio. So that is where we are. Financial ratio. So if you look at the buying price against the selling price, you get the difference. That is what we call, that is where we are. So financial ratios are items that are used to compare at separate stages of the trading period, be it quarterly, can be half yearly, or it can be yearly or annually. So that is assessment of a business. So financial ratios are expressions that are used to compare the performance of a business or of a business enterprise in different areas for proper decision making. So at the end of the year, you'll ask yourself, during the trading period, what was the percentage of the profit or loss? Did you make profit or you made loss? So from there, you can now be able to make a decision for further engagement or for further trading activities. So let us try to list some of these basic financial ratios. Examples of the basic financial ratios. So we have markup. That is the first one. Then the second one, we have margin. Then the third one, we have current ratio. Current ratio. And then the fourth one, we have roast. roast. Roast, that is examples of basic financial ratios. The first one is markup, the second one is margin, the third one is current ratio, and then the fourth one is roast, rate of stock turnover. So rate of stock turnover. I want us to look at one after the other up to the end. That will be the objective of our lesson today. So the first one, I want us to look at markup. What is markup in a business? So markup is the gross profit, the GP expressed as a fraction, ratio, or a percentage of. So markup, so this is the GP expressed as a fraction of the CP stroke COS, or GP is to CP, or GP over CP times 100. That is the percentage. So in this case, we have said markup is the GP expressed as a fraction, a ratio, or a percentage of CP stroke COS. Down there, I wish to explain the abbreviations. So GP refers to gross profit, and then CP means cost price stroke COS, that is cost of sales or cost of goods sold. So GP means gross profit, and then CP means cost price or cost of sales or cost of goods sold. The cost of the goods that you are selling, the amount of money you spent, the resources you spent on the goods that you are now selling to your clients. That amount of money is what we call CP, cost price, or cost of sales, or cost of goods sold. The cost of goods that you are selling or you've sold. That is the that's called CP or C. So how do you find markup? So you can either calculate it as a fraction, that is GP over or GP divided by CP or COS. Alternatively, you can get it as a ratio, or you can get it as a fraction. So let us work out an example. Given that gross profit is 30,000, so if we have GP 30,000, gross profit 30,000, if GP is 30,000, and then cost price, that is the cost of goods sold or cost of sales, is 50,000. So in this case, I want us to calculate the markup in form of a fraction. So markup, that is GP over CP. So this is GP, that is 30,000 over 50,000. Now in this case, if you cross the three zeros, you cross them, so this is 3 over 5. That is the answer. If you are calculating markup as a fraction, it is 3 over 5. Or you can calculate GP is to CP, that is 30,000 is to 50,000. So in this case, you will still cross the three zeros, so we have 3 is to 5. That is the answer under markup calculated as whereby GP is calculated as a ratio of the cost price. So that is 3 is to 5. Or it can as well be a percentage, whereby we have 30,000 if we have 30,000 times that is over 50,000 times 100. Remember, at all times the original percentage is 100, so we want to calculate this one as a percentage. So this is 100 times 100. So if we get this crossed with this one, it cancels. Then we have got 5, cancel 5 once, and then 5 cancels 120 times. So to get the percentage here, this is 30,000 divided by 50,000 times 100 to get the percentage. So we have crossed, cancelled the zeros. We are left with 5, cancelling 5 once. 5 cancels 120 times. So in this case, 20 times 3, this is the markup here in form of percentage is 60%. So in an exam, it depends with the examiner's dimension of the question. If he has requested you to calculate the markup basing on the percentage, this is what you'll do. If he has requested you or you've been required to calculate the markup in form of a ratio, this is 3:5. If it is in form of a fraction, then it's 3/5. So that is markup. That is how we calculate markup. So the gross profit. So you must have gross profit made, the profit that has been made, and then you get the cost of sales or cost of goods sold or cost price. Then you divide the two. That's how you arrive at the answer of markup. Next, we look at margin. Now, margin, what does the word margin mean? Margin refers to a difference. It can be used to refer to the difference. So, what was the margin between candidate number 1 and candidate number 10? There was a very small margin. There was a very slight margin between candidate 1 and candidate 3. So, margin may be explained as a difference. But now, in business terms, margin is the gross profit expressed as a fraction, a ratio, or percentage of the selling price. A fraction, a percentage, or a ratio of the selling price. Margin. Margin. So in this case, now if we still look at the figure of gross profit as the same, given that gross profit or GP is 30,000 and selling price is 60,000, gross profit is 30,000 and then selling price is 60,000. So you are now you want to work out the margin. It can either be a ratio, it can either be a fraction, or it can be a percentage. That is margin. So working using the two figures above, we are going to have 30,000 over, so we have got 30,000 over 60,000 as a fraction. That is margin as a fraction. So 30,000 over 60,000, you cancel 1, 2, 3, 4 zeros. 1, 2, 3, 4 zeros. So 3 cancels 3 once. 3 cancels 6 twice. So this is a half. Margin here is a half. A half. So In this case, we can now look at the margin as a ratio. So it is 30,000 is to 60,000. So this ratio, you cancel this one, you cancel this one. So this is 3 cancels 3 once, 3 cancels 6 twice. So this is 1 is to 2. That is the answer. That is the answer basing on the ratio. And then we look at, then we can look at the percentage. So it is percentage. At all times, remember, the original percentage in all mathematical or arithmetical calculations is 100. So we have got 30,000 divided by 30,000 divided by 60,000 times 100. So 0, 0, 0, 0, 0, 0. And then we have 3 cancels 3 once, 3 cancels 6 twice, 2 cancels once, 2 cancels 100, 5, 0. That's 50. So this is 50%. That's margin. So that is margin. That is margin. Now that is financial ratio number 2. Then we come to current ratio stroke working capital. Current ratio stroke working capital. So current ratio stroke working capital, this is the assets. Current assets expressed over current liability. So this is current assets expressed as a fraction, a ratio, or a percentage of the current liabilities. That is current assets expressed as a fraction, a ratio, or a percentage of the liabilities. Now, in this case, what is the difference between an asset and a liability in a business? Now, if somebody tells you that you are a great liability to me, what does it mean? Or you are a great asset to this family, you are a great asset to this organization, you are a great asset. For example, I am a great asset to KUTV because to KUTV and the Kenyan child. Because right now I am imparting knowledge in the Kenyan child across the Republic of Kenya. So I am an asset. So an asset is a property that is useful, a resourceful property to an organization, to a person, or to an institution. And a liability is a burden. A liability is a burden. So when somebody tells you you are a liability to this society, that means you are a burden. You deserve to be deleted from the third planet. So a liability is a burden. An asset is a resourceful property. So in this case, are you an asset to the society, to your society, or you are a liability to your society or your family? So let us look at the workings here. Current assets expressed as a fraction, a ratio, or a percentage of the current liabilities. Now let us name some of the current assets of an organization. Those properties that do not last longer. For example, less than 1 year, to say. An example of an asset, we have got stock. You buy stock today, after 1 week, it's sold, it's out of the stores. So stock is a current. Current means for that period of time that's on, that existing period of time, not tomorrow, for now. That is current. So stock is current asset. Stationery. You buy stationery today, you use it, it's over. You buy stationery right now, after a few hours, it's finished. So current assets are those properties to an organization that do not last longer. Especially they always last for 1 year, say. So for this reason, another example of a current asset. Now, let me ask, where do we place animals and birds? Domestic animals and birds, where do we place them? Are they current assets or fixed assets? They cannot be fixed assets. They are current assets because an animal can be slaughtered, it can be liquidated. So, and then we also have other examples of current assets: cash at hand, cash at bank, the debtors. Those are current assets, the properties that do not last longer. So let us look at the current ratio. So given that the total current assets is 90,000, total current assets 90,000, and then total current liabilities is 80,000. Total current assets 90,000, and then total current liabilities is 80,000. So in this case, we can have total current assets. We are still on the current stock working ratio. So in this case, current ratio stroke working capital ratio. So we have got 70. We have got the total current assets equal to 90,000 and total current liabilities equal to. So in this case, we can say 90,000 is to 80,000. 90,000 is to 80,000. Now, if we can cross these four zeros, so this is 9:8. That is the ratio. That is the ratio. 9:8. And then we can also look at it as a percentage. If we look at it as a percentage, 9:8. So this is 90,000 divided by 80,000 times 100. So this is 0, 0. Then you are left with it. So 4 goes here. 4 goes here. 25. Now 25 multiplied by 90. So if we can have 25 multiplied by 9, so this one we have 9, that's 45. 5 carry 4, that's 9 by 2, that is 18 plus 4, that is 22. So 225 divided by 2, 2 goes here 1, 2 goes here 1, 2.5. So 112.5%. So this is, you are finding either the ratio, the percentage, or the fraction. That is the current capital, the current ratio. It is called current ratio, or the current, okay, the current ratio or working capital ratio. So in this case, that is, those are the calculations of that particular financial ratio. Then we look at the what we call ROST, R-O-S-T, rate of stock turnover. Now, when you talk of the rate, what is the rate? What was the rate of production? What was the rate at which products were produced? What was the rate at which stock was bought and sold? So when you talk of ROST, you are talking about the rate at which the number of times stock was bought and sold. For example, you go to the supplier, you get the goods, you dispose them, that's 1. You go again, get the goods from the supplier, dispose them, that is 2. Go to the supplier again, get the goods, dispose them, that is 3. Now, if you are asked, what was the rate of stock turnover? Goods were bought and sold 3 times. So in this case, the answer you get should be 3 times, 1 time, 4 times, 5 times. It's not a half a time. So it is 1 time. They were bought and sold once. They were bought and sold twice, or 2 times, or 3 times, or 4 times, or 5 times, even 100 times, depending on the period of time and the speed at which the demand is looming. So in this case, ROST refers to the rate of stock turnover. So ROST refers to the rate of stock turnover. We can look at illustration number 4. Illustration number 4. That is under rate of stock turnover. Illustration number 4. Yes, illustration number 4. Now, if we assume, no, not assuming, we have the figures there that rate of stock turnover is calculated as the average, that is the average stock. That is the average stock over the cost of goods sold, or as a percentage, or as a fraction. That is, we have said the term turnover means net sales. Therefore, ROST means the speed at which stock is bought and sold. That is how many times was stock bought and sold. So it is the cost of sales, or cost price over average stock. Now, how do you get the cost of sales? The cost of sales refers to the cost of goods sold. We have seen earlier that cost price, or cost of sales, or cost of goods sold refers to the resources you spend on the goods that you are selling, or anticipating to sell, or you already sold. So how do you find the cost of sales? Cost of sales is calculated as opening stock plus purchases minus closing stock. That is the cost of sales. Opening stock plus purchases minus closing stock. And then average stock is calculated as opening stock plus closing stock divided by 2. That is opening stock plus closing stock divided by 2. So this is the illustration that if we had stock here, if we had stock at the beginning, stock at start, stock on 1st January, and then we have got stock on 31st December of that respective year. So stock on the 1st of January be 50,000, and then stock at the end be 30,000. So this is 50,000, 30,000. So stock at the end is 30,000, and then stock at the beginning is 50,000. Purchases 100,000. Purchases 100,000. Now, what is the difference between the three? That is stock at the beginning, stock at the end, and then purchases. So stock at the beginning. Stock at the beginning, you wake up in the morning, you are a greengrocer. The stock that you closed with at night yesterday evening, that's the one that you are coming to find in the store early in the morning when you open the greengrocer. Then you realize that this stock will not push you till evening. You've woken up, you found out that you had stock worth 30,000 at the end. Then you realize that this stock is not enough to take you through to evening. You go to buy more goods to top up or to restock again. So the goods you've gone to buy to add on what you have is what we call purchases. The goods that you go to buy to add on what you have is what we call purchases. So then as you continue to sell these goods till evening, you realize that you are closing the shop or the green grocery shop or your green grocer with still with a particular amount of stock in the shop. That is what you call closing stock. You are closing the day with a particular stock. That is closing stock. Stock at the end of that trading day is called closing stock. And then stock at the beginning of that trading day is called opening. So the closing stock is the opening in the following day. So if you close with the stock worth 30,000, in the morning you will open with the same stock worth 30,000. Then you add more stock called purchases. You buy more goods to add on what you have in the morning. That's what we call purchases. So that's the difference between the three. So how do you get the cost of sales? So cost of sales or cost price is equals to opening stock plus purchases minus closing stock. So in this case we have 50,000 plus 50,000, that is opening, plus purchases 100,000 minus 30,000. So in this case we have the answer here will be 120,000. That is the cost of sales. 120,000. That is the cost of sales. Now we have already gotten one part of this question. That is the rate of stock turnover. Now I want us to look at to find the average stock. So average stock is equals to opening stock plus closing stock divided by 2. Opening stock plus closing stock divided by 2. In this case, 30,000 plus 50,000 divided by 2. So this is the answer here. This is 80,000 divided by 2. That is 40,000. 40,000. Now 40,000. So we have said that roast is equals to cost of sales over average stock. Cost of sales divided by average stock. So in this case, the cost of sales is 120,000. Average stock is 50,000 plus 30,000 divided by 2. That's 40,000. So we are going to have, that is 40, the cost price expressed as expressed over the average stock. So in this case, we are going to have 120,000 divided by 40,000. 120,000 divided by 40,000. What do you get there? So you cancel 0, 0, 0, 0, 0, 0, 0. You are left with the 12 over 4. 4 cancels 4 once. 4 cancels 12, 3. So in this case, stock was bought and sold 3 times. Are we together? Stock was bought and sold 3 times. Stock was bought and sold 3 times. So that is rate of stock turnover. That is how you calculate the rate of stock turnover. That is roast. Now, before we move forward, I want us to I want to drive you a little bit back, and then we look at this under this expression of roast. It has got 3 stages. Stage number 1, this question has got 3 stages. Stage number 1, you must find the cost of sales. Calculation of stock or cost of sales. You have been given stock at the beginning of the year. you have stock at the end of the year, and then you have the purchases, and then you can have other things like return inwards, returns outwards, return inwards, returns outwards. So if you have such things like returns inwards and returns outwards here, what is a return? Return inwards. Inwards means back to the business. Outward means out of the business. For example, if you bought stock, you purchased stock for selling, and then you bring it to the business, to your business premises, and realize that particular part of that stock is unwanted, you take it back to the supplier. You usually use the terms back to the sender. Now this one, you are giving this stock back to the supplier. That is what you call returning out. So those are returns outwards. Then if you sell to a client a particular product, then the client brings back the product in the name of it's defective, it's maybe of a lower value, of a lower quality or quantity. So you bring it, you take it back and give them back their money. That is returns inwards. So returns outwards is subtracted from the purchases. So if you purchase, bring it to the business premises, then partly you return back to the supplier. You subtract from what you have. You subtract from the purchases. Then return inwards, the client or the buyer has brought back the egg you sold. If you had sold 20 eggs, and then a particular customer brings back 2 eggs, that means the eggs you had sold, if you are selling 20 shillings each, you had made 400 shillings. That means if you get the 2 eggs back, you are going to give back 40 shillings. So 40 shillings will not be part of your sales. You subtract, you take away. So that means that's now not part of your sales. So returns outwards is subtracted from the sales. And then returns inwards is subtracted from the sales. And then returns outwards is subtracted from the purchases. So that is the difference. You can have such terms here to be confused. You know, examiners are always very funny. They want to test your intelligence. It's not that they want you to prove how poor you are in memory, but they want to test your intelligence. So you need to memorize to know each and every area. So the 3 areas I was talking about, you calculate the cost of sales and then calculate the average stock, and then you now work on the rost, the answer. That is cost of sales divided by the average stock. That is how you get that. So stock was bought and sold 3 times as we have seen them. Lastly, we can look at return on capital. Return on capital. So we can look at return on capital. So what is return on capital? We have looked at margin, markup, current ratio, ROST, R-O-S-T. And then lastly, we want to look at return on capital. So return on capital, it refers to the net profit expressed as a fraction, percentage, or ratio of the capital invested or capital employed. So capital invested, net profit expressed as a fraction, a ratio, or a percentage of capital invested. So if we can say net profit is 100,000, net profit is 100,000. So net profit is 100,000. Then capital employed is 400,000. Capital invested 400,000. So in this case, we can have 100,000 is to 400,000. That is, you cancel this, you get 1 is to 4. 4. That's the answer. Or as a percentage, 100,000 divided by 400,000 times 100, that is 0, 0. So that is 100,000 divided by, so this one we are going to get 100. So this is the zeros, we are going to get 100%. And then if we can have it as a fraction, it is 100,000 over 400,000, that is a quarter. So those are the answers. That is return on capital. Net profit expressed as a fraction, percentage, or a ratio of capital invested. How do you get net profit? Net profit, it's gross profit plus revenues minus total expenses. Gross profit plus revenues minus total expenses. Remember, part 1 of this topic, subtopic 1, the trading profit and loss account, we looked at how to find how to prepare a trading account, a profit and loss account, and also how to calculate gross profit and net profit. Section 2 and final phase, it's basic financial ratios. Maybe next time, God willing, we are going to look at the topic of money and banking. If God is going to give me the grace to be back to this platform, we are going to look at money and banking. That is still in book form. We are going also to get time to look at how to answer questions in paper 1 and questions in paper 2 before the end of this holiday. So thank you very much for the great opportunity and great time to all our viewers who have given us your audience wherever you are across this republic. Until we meet again. Bye-bye. Yes. Opoa, tako nipige picha hapa. Mtu amepiga hapa sana.
wa viongozi wa chama cha wavuvi katika eneo hili.
Zaidi tunajaribu kuwapa chanjo ili ina boost ama inanyanyua kinga ya mwili, hiyo inaweza kupelekea kupambana na virusi.
Ni Duniani Leo, Jumatatu mpaka Ijumaa, moja kwa moja kutoka VOA Swahili, Washington DC.
Are you an aspiring media practitioner, a graduate, or you just want to advance your skills in television production? Then welcome to Kenyatta University, where education meets innovation. KUTV, the premier university television station in Kenya, is now offering short courses in TV studio, field technical operations, and video editing. Through these courses, you will acquire hands-on skills on camera operations, media production, lighting techniques, audio-visual editing, and sound and visual control, and how to operate key equipment in modern TV control room. Enroll today at KUTV and discover your full potential in cutting-edge TV broadcasting. Graduates of these courses will receive professional certificates. For more information, visit our offices at KUTV Studios or call us on 020-870-4252 or 020-870-4255 or SMS us on 0739-110-544. KUTV, a new experience.
Access to knowledge, solution to unanswered questions.
possessing your property, intellectual or material.
This and more only on Law Matters.
Ungana nami Malkia wa Taarab katika mitindo ya kipwani hapa KUTV. Yaani tunapozungumzia mitindo ya kipwani basi unaona napigwa na mawimbi makali sana ya baharini kutoka katika ufuo wa hoteli moja inayofahamika kama North Coast Beach Hotel, ambao ndio wadhamini wa kipindi hiki cha mitindo ya kipwani. Penzi mtazamaji, kwenye mitindo ya kipwani hutakosa kupata mapishi ya vyakula vya kipwani. Yaani hapa tunazungumzia vyakula vilivyokolezwa na kukorombezwa. Iliki, karafuu, abdalasini, samaki wa baharini, vyakula vilivyopikwa na kusukwa kwa kutumia nazi. Bila kusahau mazungumzo ya moja kwa moja, mazungumzo ya kusisimua na wataalam tofauti, waandishi wa vitabu waliobobea, watunzi wa kuhani mashairi. Bila kusahau mpenzi mtazamaji, taratibu zetu za taarabu na chakacha. Yaani pale ni pale ambapo viuno vya wanawake vinazungushwa kisawasawa kama panga boy za trekta ndani ya KUTV mitindo ya kipwani. Ukiwa nami na hodha wako Waridi Tamu. Usiakose matamu jamani.
Ni nguzo na uso wa jamii. Kupanda shuka akawa tuzo, ukakamavu wake ukatii na kumfanya mwenye bidii. Kwa machozi na makeke akabaini jinsi ya kuwini. Huyu ni mwanamke ngangari kwa jinsi alivyo ng'ari. Mimi ni mwanamke mwake. Usikose kutazama kipindi cha mwanamke mwake nami Caroline Kimweli.
This program is rated GE. Content carried in here is suitable for general family viewing.
Hey friends, I'm so glad you're here. In today's story, we'll learn together with Nuzo and Namia on the importance of predicting and valuing others. These skills make you and everyone around you better people.
Who have you met today? Did you value them? Thinking about such questions is important in keeping our minds sharp and active.
Then, after the adventures with Nuzo, Namia, and Bubelang, we will hear from different inspiring people